We went from 16K per month to 1.6 million per month in only 30 days. And this video is going to be about the full e-com operation logistics behind scale like this. We have a separate video about the front end side of things, so how to achieve this level of scale in marketing. This video is going to be about the back end side of things, operations, logistics. It's going to be a full 2025 up-to-date guide, and mainly what's the exact backend infrastructure you need to achieve those 7-figure months yourself. We cover a lot of things, so for example, logistics, inventory planning, supplier setup, capital allocation, how we manage them across multiple high volume brands. So a lot to cover, but first let me show you that this is actually real. So here you can see the before and after screenshots, but I'm going to go into Shopify to really prove that this is real. Let me refresh for a second. And now if I go on October 2024, we were at 16K per month. And then in November 2024, already at 1.6 million per month. You might think this is luck, but no, we followed up with another 1.5 million in December 2024, also with very healthy around 25% profit margins. This was no luck, no outside funding, just a dialed-in growth strategy, and more importantly, an operational backend that doesn't break under pressure. So a lot to cover. Let's dive right in. All right, first things first, growth exposes weak operations. If your backend isn't built for scale, the very thing should be exciting. So scaling to 1.6 million this quickly will break a business completely, because even a tiny elevated dispute rate will shut you down completely. So you have to be very paranoid in a way. And I'm going to show you how to calculate the exact levers, so you know what to fix exactly in your own business before you scale any further and maybe break your ecom brand without knowing it. You have to ask yourself questions like this all the time when you scale this quickly. So every day, basically, can your supplier fulfill? Do you have stock? Is your 3PL integrated? Is cash set up in inventory or waiting in the process? Of course, this is basic and simple stuff, and we're going to go much deeper. But if you scale this quickly, you have to really be paranoid with those things, because every sale triggers a chain reaction. That's why I put this chain reaction picture here. And if only one link fails, then the whole machine will stall or eventually break. So let's break down how to build a backend to sustain scale, and more importantly, how to calculate these KPIs for yourself. Let's first talk about supply chain and logistics. The first question you should ask yourself is, what's your total turnaround time, if you haven't already? If you're not familiar, turnaround time is basically just the time that passes from purchasing order with your supplier to you having actually sellable inventory. So like, when do you fill the order form with your supplier to like get inventory, and when is your inventory ready in your warehouse, ready to be shipped, ready in your Shopify? And this includes everything in between, so production lead time, quality inspection, freight, customs, inbound receiving, fulfillment activation, and maybe more things depending on your niche. And also, if you rely on launching a lot of new products, then you have to also calculate your sample turnaround time. But more important is your total turnaround time for your evergreen average product. But of course, if you rely on like launching a lot of new products, which a lot of people I know do, then you also have to calculate your lead turnaround time. So that's going to be your sample lead time on top, sample lead time, and quality inspection. And normally it's going to be like a bit more quality inspection, because you find something in the sample you don't like, send it back, get a new sample, send it back. So a few iterations, and depending on your supplier, how good he is, how he understands what you want. If you have like local agents on site, it's going to be faster. But we are mainly going to talk here about your total turnaround time for really like evergreen products. Let's go through every point here. So if you're not familiar, production lead time just means like, how long does it take your supplier to actually manufacture the product you want from them? Then quality inspection, also quite self-explanatory, like you check the product, or your team or your interns, is the quality good? And once again, this is not like the initial check for the samples. This is like for every batch you get, like checking the products, like how long does it take you for your average product? Normally it's quite quick if you're pretty dialed in, but especially at high numbers, could take a bit more time, right? So calculate your average inspection time per item. That's important. Then freight, pretty clear, like how does the product get from A to B, depending where you produce, maybe China, maybe South America, North Africa, the Arabic world, really depends where you are. But how long does it take you to get from point A to point B? Then, of course, customs, where we all love. How long does the government take to re-inspect the products? Once again, on average, because this changes, it's not in your hands. Then inbound receiving, how long does it take for you to like unload everything at the warehouse? Once again, depends on how much you receive and how regularly, but once again, calculate the average per unit. And then fulfillment activation, when is it ready to ship to customers? Maybe little things have to be done, have to put in the ERP system. So once again, depends exactly. Normally, I would say inbound receiving is super quick, fulfillment activation too. Also quality inspection for regular products. What's a bit out of your hands or more out of your hands is production lead time, freight, and customs. That's why it's important to regularly calculate total turnaround time, because it changes per batch normally. Maybe there's a congestion in the Suez Canal, or tariffs or Chinese New Year or whatever. So really have to calculate this regularly and see if there's changes, because this is what you are going to base a lot of calculations on. I don't want this to be a video where you just sit around, do nothing. So here's an action step. Really maybe pause this video and pull up your last order in Shopify and really just see, like, from this batch, from this product, how long did it take you from purchase order to sellable inventory, right? So like, what's your turnaround time for your last item? Mainly, how many days did it take you from PO to live stock? I would say normally, so you get a benchmark, is 30 to 90 days. Yes, it's a big range because it's an English video. It's going to be watched by a lot of people in different parts of the world. So it really depends on where you are, how you transport things. But I would just say, like, to give you a rule of thumb here, if you're within this range, you first of all, good to go. Of course, you should always aim for optimizing your turnaround time. But if you're within this range, you are good to go, I would say. Of course, optimize. But if you're like 120 days, then you should really look into your turnaround time. This is the first thing you have to do, which brings me to the next point. Shipping. Most shipping companies give you 3 options to choose from the classics. You got air freight, you got train freight, and you got sea freight, right? So first of all of those numbers are like basically rule of thumb numbers, benchmarks. People always ask me, okay, give us some benchmark numbers. So please don't comment here, okay, but my train takes 36 days or 28 days, right? This is benchmark numbers, so you just roughly know what to aim for. It really depends on what exact country you are, especially with sea freight. Right now, there's a lot of delays because of tariffs and the Houthi rebels, right? This is just benchmark numbers. But normally, air freight would take around 5 to 7 days door to door, so very, very fast. Train freight, you would expect around 30 to 35 days, and sea freight, 45 to 50 days. Really depends on the ports. And, for example, Chinese New Year, or what I just mentioned, the Houthi rebels, or like some congestions in the Suez or Panama canals, right? So this is a bit more unreliable these days, but normally would expect 45 to 50 days. And at first glance, would say, of course, I go with air freight because air freight is the fastest. It's the option that makes the most sense. But here's the thing, weight matters. So the difference is air freight is priced per kilograms or per pound, and sea and train freight is going to be priced per cubic meter, right? So what does this mean? If you sell small, light products, so supplements, for example, small electronics, books, so everything that's lightweight and small, air freight might be the most viable option for you. But if you have like heavier items, so I don't know, like home goods, furniture, everything is really bulky or heavy, then normally you would have to go with train freight or with sea freight, right? But here's a trick, like most people miss. Like, nobody says you have to just choose one of those options. At best, you have everything implemented, especially because you need some redundancy these days. If, as I just mentioned, ships are stuck in some port or some canal or take 1 month longer because there is some attack. I don't know. So a hybrid strategy is the best these days. And what you want to do, what we would recommend, is you're going to use train freight and sea freight for your baseline stock. So everything you really know, okay, I'm going to sell this stock anyway. This is my inventory. I can plan with. That's always worked for me. Have your baseline stock planned well in advance with train freight and with sea freight, because they take longer than air freight, but are cheaper usually. So you're going to have your baseline stock with those things. And then when you want to scale your ads, you're going to bridge the gap with air freight to really prevent stock outs. And the thing is, of course, it's always bad when you don't have stock, because you make less sales, and some customers get frustrated because maybe they think, oh, it's just a strategy that's some artificial scarcity, right? And it damages a bit of brand trust. But more importantly, and most importantly, in my opinion, it kills ad momentum. So if we scale this fast from 16K to 1.6 million per month, right, we want to keep the momentum going. If we have an ad that's running well, or ads that are running well, we want to scale them up as much as we can. We do not want to be prevented by stock outs. And that's what I mean when I say, like, we need a backend that's able to scale, right? Because if we find a winning ad, then we don't want to scale them down just because we don't have stock, right? So we want to bridge the gap to prevent stock outs. Yet it's more expensive, but you can optimize that longer, because then you have a new baseline stock and going to move this like gap you've bridged to like train and sea freight, and then like after those periods, you're basically cheaper, and then you hopefully scale even further and do the same thing with air freight once again. So it's going to be more expensive to have air freight, but it's, in my opinion, when you scale quickly, just what you need. But it comes down to one thing, which is unit economics. So of course, you need to know, can I even afford to do this hybrid strategy to be able to afford air freight for every marginal new product you sell? If you have a margin of plus 60%, I would say you're good to go. Once again, this is like just rough rule of thumb numbers. And here you really want to calculate everything. So like, what's your margin per product, after product cost, after shipping, after fulfillment fees, even returns, don't forget the returns. And if you're above 60%, then I would say like go for air freight. If you're below 40%, then I would say first stick with train and sea freight and first before you really scale aggressively, build your margin up through smarter sourcing, maybe like move to a factory in a country where there's no tariffs or something that's closer. Do like on the market side of things, bundling, upsells, make maybe inflation adjust your pricing to have better margins, have a continuation offering, so some subscriptions maybe on top of your physical products, have a digital product. There's a lot of options here. Revenue recovery, if you have issues with like returns and disputes, and unhappy customers, there's different things, but you have to somehow get your margin up. And first, when you reach this level, and then I would say like go for our recommended hybrid strategy. We actually have a video about all of this, how you do this. Same case study, but more about the front end side of things, what I mentioned, like the creative ad strategy, setup revealed, where we cover all of those things, unit economics, because they just matter a lot. And here you're going to learn like how to calculate them and how to structure your price and really unlock scale. Because if your unit economics are off, then no real shipping strategy will save you, right? So it kind of all ties together. So I can recommend you to watch this video too if you have a free minute. Okay, now that we got our turnaround time figured out, now let's calculate how much stock do we actually need. And this is an example of a stock control chart. So from the traditional business, so this concept has been around for a while and it's not new. And if you're like a big corporate and you have like a lot of suppliers and a lot of intermediary products, it's going to be much more complicated. But I just want to say this concept has been around for a while and you should think about it, right? So here's a calculation to get you started. How to calculate your minimum stock. Minimum stock, we would recommend you to calculate daily sales, so average daily sales on a normal day. So really leave out Black Friday or like seasonal stuff. Average day daily sales times the lead time times the turnaround time. So if we do an example, for example, you sell like 500 units on a normal day and your turnaround time is 40 days, then that would make the minimum stock 20K units. You should always have in stock to really be safe. So this is the minimum stock, and if you're like a lean brand, you're just starting out, you have to be a bit tight here, and we recommend to like stay with the minimum stock. But if you have the possibility, if you're like a bit more sophisticated, we'd always recommend that you like really calculate buffer in. Normally 10 to 20%, depending on your possibilities. You don't want to have too much inventory because it binds capital, of course, but you know how it is. There's things happening, right? Delays happen. Maybe a team member quits. Demand spikes happen. An ad goes viral. And tariffs happen. Donald Trump happens. Life happens, right? So just like always, be realistic and calculate a buffer in. And that's why we recommend aim for a target inventory of the same calculation. So daily sales times lead time times 1.2. So like a little buffer, which would make it like 24K units in this example. And somewhere be in between here and really like look what's possible for you. We want to keep it lean, but also have like inventory, because especially if we want to scale up fast, you need to be thinking about things. Once again, this is like rules of thumb to get you started. Really adjust this for your niche and for your experience too. But especially right now, there's a lot of congestions happening, trade war, right? Tariffs, right? So you have to think about those things even more, especially these days, right? But what's the challenge here? This is linear forecasting. While we're assuming ad spend and sales are stable, right? It's very easy to say like, oh, every month I'm selling like 5K units. I need, and this is my turnaround time. I need to plan ahead, but we want to scale aggressively. And this example was 100x in 1 month. So we have to have a more dynamic model to see, okay, how do like our forecasts or our inventory like what we need in inventory change when we scale up ad spend quickly, right? So if we scale it from 10K a month, 20K to 30K to 40K to 50K, how do we factor this in, right? So this is a dynamic model, right? And we are optimistic. We always think it's only going up, but it's going to go down. You have to sometimes scale back, or you scale too aggressively. So really have like a realistic model if you think about those things. You may scale down, maybe it's seasonal. Really just like look back from your experience, but have a realistic scenario, because otherwise, if you just calculate with this, you're going to have too much stock and too much capital bound in inventory, which is also very, very bad. So we want to have just enough to be able to scale, but not too much really. And this is honestly really where sales forecasting meets media buying, marketing logic. And that's why I would implore you to really watch the other video we made about the front end side of things, because they all really tie very closely together. But how do you start doing like a dynamic model or a dynamic forecast? Once again, like a calculation to get you started, I would say like, hey, first step, calculate your average daily sales volume for the past 3 months. And then also do this if you like have a very seasonal business, do this every month for the past 3 months and the past month. So you always have different numbers to compare and see how like trends maybe change. And then what you want to do is you want to see, okay, what's my current CPA, how much I'm currently paying to acquire a customer, and what's our target CPA. And then calculate your break-even CPA, so what's really like the bottom you can afford in CPA or in ROAS too. And then see what's your target that you also have a good margin on, but you're able to scale with, right? So the target CPA is normally going to be somewhere between your current CPA and the break-even CPA, right? But not, if it's just this break-even CPA, then you don't make any money, which doesn't make sense, right? So it has to be a target CPA that's in between, so you make money. And there's for every brand, there's an equilibrium where what's the perfect CPA where you sell enough and scale quickly, but also make enough money, which is the whole point of this, right? And then you want to see step 4, what's the CPA trend? Normally, when you scale this aggressively, it's going to go up. It's just normal, because if you scale up, there's going to be some things that break, and if you want to be fast, you can't be perfect, right? So it's going to go up. It's totally normal, and ROAS is going to be down normally, but you want to have it like a very close eye on those things. That's why I said like past 3 months, past 1 month, if you scale very aggressively, or you're already at a higher level, even the past week maybe, just to see if the trend is right. And then you want to calculate the variance in the trend. It's just a fancy way of saying, okay, what's the patterns in like our CPA and ROAS. So for example, you see a pattern, okay, every time we increase spend by 20%, our ROAS goes down only 10%, which would be a good pattern, right? But if you see, okay, every 20% increase in spend is going to trigger like a 30% decline in ROAS, then like you're going down and maybe down too fast. But anyhow, that's like a good way to get started and really start having a realistic growth curve. And you want to model out different curves, so different scenarios. Once again, it's forecasting, so it's imperfect, but just, have different scenarios. What happens if we double spend? How do our CPAs, ROAS change normally? Or from your predictions, maybe you had the same scale up already in last season, right? Or what happens if we only scale it up by 20%? Have different scenarios here, and then really calculate like different models and factor this into your target inventory calculations. And, this is how you get started, like building a dynamic stock planning model for yourself. Once again, very individual. This is a video that's going to be watched by many, many people. So really adapt this to you and always revisit your inventory plan. That's why I said like always look back, because if you, for example, think, oh, every 20% increase in spend is going to give me only a 10% ROAS decline. But then you find out in hindsight after 3 months, it's 100% and you maybe lost money, but you didn't realize it. That's going to be very bad, of course. So really if you scale aggressively, you have to have a very close eye on those things. But this is how you build or start building a dynamic stock planning model that prevents stockouts without overbuying, so you don't have too much inventory, and also based on future demand and not just past sales. And once again, I have to say it, forecasting is imperfect. Looking into the future, nobody knows what happens in the future, right? Good example is the tariffs and the trade war stuff. So restart conservatively and then readjust every month by the percentage you are off, because that also shows you, okay, how optimistic or pessimistic am I if you calculate the percentages in. So really, it's imperfect. Start by using those things, do different calculations, different growth curves, and then always readjust for the past 3 months, past month, and if we scale very aggressively, even the past week. Okay, let's talk sourcing, because suppliers can make or break you really. In this example, in this case study, they used a hybrid approach. So they sourced OEM manufacturers straight from Alibaba and then verified them with import Yeti, see who they're shipping to, and then negotiated really good payment terms. So a thing in this example was like 1090 payment terms, which means 10% deposit and 90% upon delivery, or even net 30, so only after 30 days. And this really depends on the leverage you have, like how big your brand is, right? And how much export volume you can really prove. But of course, you want to get the best payment terms here. And this is going to improve if you get bigger and you get more negotiating leverage, really. And then also actually go into China, not just watch YouTube. So really go to China and be a real business owner. Because if you want to scale this fast, you also have to do things other people do not, because China is a lot about trust, right? So actually go into China and also have like local people on site, right? First of all, maybe if you're not familiar with the term OEM manufacturer, so OEM stands for original equipment manufacturer, and it means different things in different industries, but it's basically the factory that actually produces the product, and normally they're like white label and don't put their name on it. And in traditional business, there's like a distributing company, there's a retailer, and then there's the consumer. In our world, the ecom world, we only have like OEM and of course like you in between, and then the consumer, right? So it's a bit much shorter. If you're like a car company that has a lot of parts that need to be put together, or like rare earths, you're going to have like more of those underneath the OEM manufacturer in the supply chain, right? So that would be the parts suppliers, right? If you're like in selling cars or something, right? Just to explain this concept, but in our world, OEM just means who really manufactures the product, because sometimes it's not the people you talk to and you think they are. That's why it's also helpful to go to China to really check what's going on site, really. And if you want to dive deep, you can use Import Yeti. I can recommend this website. You can analyze your competitors and see from which factories and suppliers they order. And then once again, with your OEM, how much export volume can you prove to get the best payment terms, and really ask for what's the payment terms for 1K units, 5K, 10K units. And the thing is, you might think it gets better like the more you order. So if you like get 100K units, it gets even cheaper, but normally the price curve flattens out after around 10K units, right? So like, of course you get normally benefits, but not as much as you might think. And the marginal benefit really is not as high as it should be. And if we're like a lean ecom brand, we want to keep it lean and, of course, get like economies of scale benefits, but not over order, because if something happens and we sit on all the units, all the inventory, that's like very, very bad. So like a big misconception is really that bigger orders also mean bigger deals. It's sometimes smarter to order smaller, like more frequent batches to really stay flexible here. Now, if you want to really level up, if you want to go to the pro level in the Champions League of ecom, you want to go straight to the source. You want to go to China, because what I just mentioned earlier, China is a lot about trust, and face-to-face negotiation builds trust and also gets you better payment terms normally, especially if you go there regularly. But you don't know the market normally, so you want to hire a local sourcing agent first. They are quite pricey, but they've been in the market, and it's a good way to. It's really well invested money, because they know the market, they know the factories, know who's the good people, who not, and you want to pay them in a way that's like incentivize them correctly, and then you want to have them like really find the best factories, also maybe build some redundancy for you, and then like once they have been found, then you want to go there yourself and start getting better and better, because they are going to be about the products and going to help you with the payment terms, but it's mainly going to be you that's going to negotiate better payment terms really with them. And maybe go with your agent too, because they speak the local language. They know like also how to behave in China, because it's not just about business talk. You have to start with like some small talk, tea, have a meal, right? It's a bit more relationship driven than in the West, where it's sometimes a bit transactional, which is a bit different in Asia, right? Ask about the family, like the city, it's, you want to invest in this relationship, especially if you like really want to scale big. You rely a lot on them, so you have to be very careful here, because if they for some reason offboard you, then you could be done like really, really quick. And when you negotiate, you want to first start with aiming for like 30-70 payment terms, so 30% deposit, 70% upon delivery. And then once you get more leverage, or maybe you have a bigger brand already, then like get better and better terms. And here it also helps if you're a local sourcing agent and yourself, you're going to have like some redundancy, some other factories, maybe other suppliers that you can use to negotiate better terms with your preferred supplier, because like, then you can be more aggressive, and if they offboard you, you have an alternative, right? So one thing, always push for samples up front. That's, I think, is a standard, but get everything in writing. Is a foreign country and there's no systems for you to, even if you're, even if you have a contract, honestly, right, to really pursue like what you are supposed to get, but still get everything in writing to really make your supply chain bulletproof. Okay, once your inventory lands, the 3PL takes the stage, and this is where fulfillment can quietly bleed you dry without you even realizing it if you don't pay very, very close attention. Once again, if you don't know the term 3PL, it's a logistics abbreviation. You can look into all those logistics stuff if you have a free minute. There's 2PLs, there's 3PLs, 4PLs, 5PLs. But in eCom, in our like lean eCom world, it mainly just means there's somebody in between, right? So like people don't use those different terms normally in eCom, because they even if it's a 4PL, they talk about it like a 3PL, right? So in our world, 3PL is the keyword you would be looking for if you want to find a 3PL. It means third-party logistics. And I found this good picture here from this company that I don't know, but I thought it was a very good explanation. If you think about drop shipping, somebody orders something online, the order comes in, and then the OEM ships it directly to the customer, right? And then 3PL just means in our world that there's like a warehouse, a 3PL company, like third-party logistics company in between, right? It arrives from the manufacturer to the warehouse, and then it's going to get repackaged, maybe going to hide the origin from China, going to add some nice packaging on some like upsell postcards, whatever, and then it goes to the customers. This is mainly what 3PL means in our eCom world. And the thing is, every pick, pack, scan, every label, every like postcard has a price tag, and even those tiny inefficiencies really compound fast. So the action step I would give you is like, when you source 3PL companies, ask often for full cost breakdown, right? So what's the cost per pick, per pack, label fees, monthly storage, software fees, and carrier integrations, and then really calculate all the costs and fulfillment cost per unit, and really what you need exactly. And once again, like earlier, what's the price for 1,000 units, for 10,000, and for 100,000 maybe, and even ask them if they're like can even fulfill it, right? Imagine you found somebody and they give you like a very good price, but then you realize when you scale, oh damn it, they cannot scale past 10K units because they don't have the capacity, right? And you need a new 3PL company, which you maybe need time to find. They give you like worse pricing, right? So check this beforehand, and once again have some redundancy in here, and once again get it in writing, because they're going to tell you, of course we can do it, because they want your business, and maybe they think, we're going to have a new warehouse anyway. Once like you're ready, really get it in writing so you know they are legit and they're not just like salespeople trying to get your business. And also expectation management with your customers. So you want to promise 2 to 3 day delivery, even if you can do it faster. So like never promise 24 hours unless your 3PL can handle it every single time. Actually, I would say like always have some like buffer in there, because things happen, and people are so sensitive these days because they got scammed by many dropshippers and unserious like ecom companies that even 1 day late can open up disputes on Stripe, on Shopify payments for you, payment holds, cash flow delays. Because just think about like what happens if like they hold my money right now. Could you handle it, right? So you have to be very paranoid here, have redundancy, of course, on a processing level, and on the 3PL level. But that's why we build redundancy. We think about those things to not have our business break when we scale up this quickly. And I found this good tweet by this guy. I don't know this guy. I just found this tweet. I thought was a good explanation. In ecom, we always think about, okay, a 1% chargeback or dispute rate is a good rate. And think about it in like, if you in the real world, that's a really good rate. 100 customers buy something, one of them is unhappy. Really good. But not for the payment companies. And the thing is, what you have to understand is you got your processor. So you got Adyen, or you got Stripe or Shopify payments, or like other more niche processors. And they sit on top of the credit card companies, so Visa, MasterCard, and Amex, that have more negotiating power, right? So the thing is, Visa, MasterCard set the chargeback rates, not even like Shopify and Stripe that do this and that are bad guys. It's more the credit card companies underneath, right? And they now lower the, as far as like I know, and like also what this guy is saying, they're going to lower it even more, right? So if you have a 0.5% Visa chargeback rate, it's already bad for Visa, and it's going to be even lower down to 0.3%. Doesn't matter if those numbers are exactly right, but it's going in the wrong direction for us as merchants. 0.3% means you sell 1,000 units and 3 people are unhappy, which is very reasonable, in my opinion. It's still an issue for Visa, right? So like you have to be very, very paranoid here. Redundancy. And yeah, that's the thing. And then to think about what I just mentioned, Stripe, Shopify Payments, they sit on top of those companies. And normally they also put a buffer in because they want to have a good reputation with the company. So they're going to maybe say, okay, if Visa tells us 0.3% is like a bad chargeback rate for them, then we're going to lower it to 0.2% just to have like some buffer in there, right? So, you're going to need chargeback alerts and redundancy really to really be paranoid here. Just want to say one more time, but to come back to fulfillment, this is the easiest way to avoid. But if you tell people, hey, it's going to come tomorrow and it's coming in 3 days, even if it's still fast, people are going to be upset because you didn't set the right expectations. Now, last section, capital and cash flow control. It's a short section, but I want to stress it one more time. The uncomfortable truth is tons of e-com brands went bankrupt because of payment holds, even though they were extremely profitable. And this is more likely when you scale very fast, like in this case study, is really be paranoid here. And also in this case study, like cash flow discipline was the unsung hero, really. So every Monday, every week, have a regular process. Sure, check your bank balance. I think you're doing this already. Pending payouts and Stripe, Shopify, other payment processors, inventory value, what's like the cash is tied up in stock. Once again, like readjust with the calculations we gave you. What's the ad spend runway based on your current CPA and also your target CPA? And always ask yourself the questions: Can we place the next purchasing order? Can we scale ad spend? Do we need to renegotiate terms? You should ask yourself those questions all the time, but really be more paranoid if you scale fast, because it's fine if you've been stable for a while to like do this once a month, twice a month. But if you scale this quickly, once again, from 16K to 1.6 million, you need to look at this like really, really regularly. Otherwise, you look back and you realize, oh, damn it, we lost money and you didn't even realize it, right? So ask yourself the main question, once again, tying this back to this tweet here of the chargeback rates that are even getting worse and worse. Always have a worst case scenario in your head. I know many people that this has happened to. So always ask yourself, if 100% of our money gets held today, how long would you last, right? If the answer is too short, then you have to fix it quickly. You have to build some redundancy, even inefficiencies here to really be on the safe side here, because otherwise, it's just risky. Like you scale 100x in 1 month and then you shut down, makes no sense really, right? So like otherwise growth is going to be like a ticking time bomb. And this case study here in general was just like not only good marketing, it was like infrastructure behind it to handle pressure, volatility, and velocity. And that's why I showed you those things. This is like the backbone you really need to start scaling. If you don't have this, don't even think about really scaling your ads too aggressively, because you're going to be shut down really quickly, right? So use all of this as a starting point. It's like, once again, rules of thumb. So think about those things and then always readjust looking backwards. Right now you get the roadmap. What's next is up to you. If you're hungry to scale to 1 million per month and you need help, you want real no bullshit advice from industry experts, I implore you to book a call for the link below this video. Talk to our team. It's a free one-on-one scaling call, and we're going to dig into your backend, dig into growth levers, and pinpoint exactly where your biggest bottleneck is hiding. Because the thing is, most brands don't crash because they didn't scale. They crash because they scaled before they were ready. So let's get you bulletproof for scale. If you're interested, book a call for the link below this video. For everybody else, thank you for watching and hopefully see you next time.